So thank you for joining us today. We have about 45 slides to go through, and this should take about 50 to 55 minutes. So for a quick introduction, my name is Rob Leclerc. I'm one of the two founding partners here at AgFunder, based in Silicon Valley. And joining me on the call is my colleague Yaniv Daron, who does a PhD at Stanford in biology and who authored the investment white paper. Yaniv will be covering our investment thesis in this webinar. But first, I'm going to need to read a short disclaimer before we get started here. So some parts of this presentation contain forward-looking statements that are subject to change. Statements include words such as anticipate, believe, and estimate or expect, and statements in the future tense are all forward-looking statements. These forward-looking statements are preliminary and expectations based on current information and assumptions, and they are subject to business and economic risks and uncertainties that could cause actual events or actual future results to differ material from current performance and expectations that are indicated in the forward-looking statements. Some of the factors which could cause the performance of our funds to differ materially from expectations include the effectiveness of AgFunder to gain access to high-quality opportunities, our ability to raise a fund of sufficient size to execute, and our investment strategy and general economic conditions. Now, if you're not familiar with us already, AgFunder is a new kind of venture capital firm. We were founded on a mission to rapidly transform our food and agriculture system through what we believe that venture capital could be a platform for change, and two, that we could affect the most change by building a platform around education, media, research, and really create an inclusive ecosystem. But first, I want to give you a little bit of backstory on AgFunder and how we got here today. So our story actually begins in Africa in the spring of 2012. After Libya collapsed in 2011, the Tuareg rebels, who were part of Gaddafi's mercenary army, had returned to Timbuktu in northern Mali, their ancestral home. And in February of that year, they had launched a major offensive against Mali's security forces. The Mali forces were basically completely unequipped to defend against the Tuareg rebels, who had brought back weapons and other equipment from Libya. And displeased with basically the support that they were getting from the government, Mali soldiers overtook Bamako and led by Captain Amadou Sanagou, who you see here. And this was sort of the final straw for Michael and I, because we had spent 3 years building up a for-profit business in Africa, working with smallholder farmers, building a pilot production facility, signing up about 1,500 farmers to work with, and securing 40,000 hectares of agricultural land in the Office de Niger. And with that coup, everything really came crashing down on us. And that experience gave us firsthand understanding that there are major challenges looming for the global agri-food sector, including climate change, failing soils, pest resistance, weak supply chains, and poor nutrition. And more importantly, we had realized that the sector was also massively undercapitalized. Investors were disinterested and didn't see this as a sexy space. And we felt that venture capital could really be this powerful platform for change in the industry. And so in 2003, when we founded AgFunder, we had the idea that a better food and agriculture system was being held back by investment capital and investor literacy. And we had this vision that we could affect this most change with this platform to educate investors, and in turn, give those investors a trusted and accessible channel to invest. Beginning with our vision of education, we started with a media platform called AgFunder News, which many of you are familiar with. This platform grew and soon became the premier source of information in agri-food tech investment and entrepreneurship. And this really created the narrative for growth in this sector and served as a magnet to attract and educate both entrepreneurs and investors to our platform. Our network grew pretty quickly, and over the course of about 6 years, we've grown to about 75,000 subscribers, ranging from top-funded startups to large agri-food companies, venture firms, universities, and more. And this has helped us to become really a big part of the center of the agri-food tech ecosystem. We've published over 2,000 articles on AgFunder News, and we get over 2 million annual visits. In the spring of 2015, we launched our first global investing report, which generated a ton of interest in the market. And this was really the first major report to take an end-to-end view of innovation occurring across the value chain from inputs to food e-commerce. And we published an article in TechCrunch. The report was cited by major publications all over the world. And we were tracking at the time about $2.3 billion of venture capital investment in 2014, which was nearly 3x year over year. And this was clearly an industry that the world needed to pay attention to. Media coverage resulted in a lot of inbound interest from startups. And so we began to build a knowledge base of these startups and just to keep track of everything. And today we've grown that to now over 30,000 startups. And we use machine learning and AI to help us identify and categorize 50 to 100 new companies each week. And in turn, this turned into another revenue stream for us as large food and ag companies and even investors started paying access for data on the market. And this allowed us to really deepen high-level relationships with most of the major players in the market and really continually improve to build our network and reinforce the AgFunder brand. By 2018, the name was synonymous with food and ag tech startups. And with the encouragement of a bunch of investors that we had, we raised our first small fund to take advantage of our unique position. And we've stuck to this strategy of raising a series of small funds and investing early and really taking advantage of our brand, global networks of subscribers to get better access to deal flow and access to a network, an expert network for due diligence support. So today we're one of the most active venture investors in agri-food tech. We've made 35 investments, including 9 from our Singapore accelerator, which we launched in September of this year with about $2.5 million of backing by the Singapore government. More importantly, the network has enabled us to have the widest coverage, see the top opportunities globally, often before most other institutional investors. And the best entrepreneurs choose to work with us because of our network and our knowledge base. We not only have the experience to help them build their business, we also can make those high-level introductions that are so crucial for early-stage companies. And many of the founders we've invested in have told us that we're one of the most value-add investors, if not the most value-add investors that they have. So the AgFunder team comes from finance, technology, science, and media. And I just want to touch on a few key members here. So Michael Dean is my founding partner. He's a former M&A lawyer. He's led billion-dollar deals, and I've known and worked with Michael now for a decade. Myself, Rob Leclerc, I have a master's in AI and virtual robotics. I went to Yale for a PhD in computational biology, where I worked under a MacArthur Fellow. I've been a contributor for Forbes, TechCrunch, and I have 2 published papers in Nature journals with over 500 citations. For the last 6 years, Michael and I have been speaking at global ag conferences on food tech and ag tech. Tom Shields is a venture partner who sold 2 of his companies for over $100 million, and in between spent 6 years as a partner at a VC firm. Yaniv Derome is our investment associate. He's a plant sciences PhD from Stanford and was named a Forbes 30 under 30. Robin Chahan is our AI expert who heads up our technology team. So Robin is building the tools to help us analyze our knowledge base of over 30,000 startups and builds AI models to help us spot top companies early to invest in. And Louisa Burwood-Taylor, which many of you may know, heads our media and research team. And this team is an amazing resource for us because of the sheer amount of ground they cover. Louisa also tipped off about a lot of new fundraisings and other rounds that are closing. And in more than one occasion, we've used this as an opportunity to get into oversubscribed rounds. Our advantage is really in the network and the platform we've built to attract some of the most amazing people in the industry. And some of our advisors and mentors in our new AgFunder Mentor Network include John Denniston, former senior partner at Kleiner Perkins, Paul Matusi, former retired GP at US Venture Partners, which is an investor in Box and GrowPro and others, Sid Gorham, who founded Granular, which sold to DuPont in 2017 for $300 million, Jason Kam, Chief Medical Officer for Peter Thiel's family office, Chris Thion, former CTO at Givaudan, one of the world's largest flavor companies, Carl Casale, board member at Syngenta and former CEO of CHS and CFO of Monsanto, Bill Buckner, former president and CEO of Bayer Crop Sciences, Adam Hanft, who's a good friend of mine for a long time, who sits on the board of Scotts, and he's one of the greatest independent branding strategist of all time. The New York Times once described him as a small advertising agency that is every large agency's nightmare. And for those who are old enough on the call, he was actually the one who devised the Flick the Bic campaign you might remember from the 80s. Rick Rubel, former president of Monsanto Brazil. Ian Pinner is SVP, who is on the executive council at Archer Daniel Midlands, one of the largest commodity trading companies and also ingredient houses. And Dave Stanges, former chief sustainability officer at Campbell. And this is really just sort of scratching the surface and giving a sample of some of the people that we have in our network. So we launched our new Carnivore fund based on a market thesis. Cars replaced horses, petroleum and electricity replaced whales, tractors replaced oxen. And despite many of the shortcomings, plastic continues to take market share from leather. And so wherever we look, humans have consistently built technologies that have surpassed their animal predecessors, and we think food may be next. And all over the world right now, we're seeing entrepreneurs are reinventing how we make the products we've traditionally derived from animals. So we're applying the latest technologies from biotech, tissue engineering, artificial intelligence, and food science. Entrepreneurs are trying to create new animal-free products that are cheaper, healthier, tastier, and more sustainable. And even if they're moderately successful, they'll have an opportunity to capture a meaningful portion of what we've calculated is about a $3 trillion animal products market. Frankly, opportunities just don't come much bigger than that. And so we created our new Carnivore Fund because we believe that focused investment, particularly at the early stage, can provide both outsized return for our investors and also empowers a more sustainable, nutritious, and accessible food system for everyone. And so now I'm going to hand the presentation over to my colleague Yaniv, who's going to discuss our investment thesis in greater detail. Yaniv.
Thanks, Rob. So I want to start by sharing with you this picture here, which shows you how vegan and vegetarian products used to be sold in grocery stores around the world, and in some cases still are sold this way. So those products used to have their own dedicated aisles in grocery stores, and they used to serve very niche customers, so particularly vegans, vegetarians, and in some cases, people with allergies. The main problem with those products is that they failed to convince the general population. And if you don't believe me, I'm going to share the rest of the picture with you. This picture was actually taken in the aftermath of Hurricane Harvey in Houston, Texas in 2017. Now, this picture really went viral on the internet because people were making fun of vegan and vegetarian products, saying that people would rather starve than buy those products. And this really represents what was the problem at that time. But a lot of things have changed over the past couple of years. And today, the landscape is dramatically different. Starting with the fact that products such as the Beyond Meat products are now sold alongside conventional meat products in the meat aisles in supermarkets. And the reason for that is that grocery store owners and executives have decided that because those products are so similar to meat when it comes to texture, mouthfeel, and taste, that it completely justified placing them alongside the products they're trying to replace. A lot of very other interesting developments have occurred over the last year. And I'm showing you here some jaw-dropping headlines that we've seen. Starting with the fact that Beyond Meat has had the most historic and biggest IPO pop since 2008 for a company of over $200 million in valuation. We've also seen other headlines, such as the ones from the New York Times and CNN I'm showing you here, where people are craving those products so much that in some cases, as soon as the Beyond Meat, Impossible, or other products hit the shelves, they're so popular that they get sold out within a few hours in some cases. Another very interesting development is that some very traditional meat companies, such as Cargill, Tyson, the Canadian Maple Leaf Company, and also Purdue, are now completely rebranding. They no longer want to be seen as meat companies. Instead, they want to be seen as protein companies. So for example, Cargill used to be known as Cargill Meat Solutions, but now they want to be known as Cargill Protein. These products are actually just a few of many other ones. So other companies that are either fast food chains, restaurants, or even companies such as Disney have all entered or at least tried to enter the market in order to grab a piece of the market. The latest addition to my list here is Mars, which has recently come up with, has recently announced that they're going to have a plant-based milk chocolate. And what's also very impressive is that this list is not even exhaustive. Every day, if you follow the news, you probably see that there are new companies that are entering the market. Now, as venture capitalists, the questions that we need to ask is there an investable opportunity here? Is this something that is going to end here, or is it going to turn into an even bigger direction? And so what we realized is that right now, there is a perfect storm that makes this market a very interesting investment opportunity. And one of the most essential features of markets is supply and demand. So what we're observing is that there is an increase in demand in the market while supplies either stagnate, decrease, or become unsustainable. So September 2018 was really a cause for celebration in the world, where we've had, for the first time in history, half of the human population that has exited poverty. So in September 2018, half of the human population was either middle class or higher. And this is going to be even more, and the numbers are even more promising as because by 2030, this number is expected to grow to 2/3 of the population. So at that time, 2/3 of the human population is going to be middle class or richer. And this does not come without its problems. And this is very well described by Bennett's law. So the law says that as people become wealthier, they switch from very simple starchy plant-dominated diets to a diversity of foods that includes a lot of animal products. And those products include dairy products and a lot of meat. And this is exactly what we've observed over the last few decades. Since 1960, the consumption per capita of meat has more than doubled. And of course, other animal products such as dairy have also really increased in consumption. The problem with this is that animal agriculture has almost reached its limits. In 2018, about 83% of the world's farmland was occupied by animal agriculture. About 1/3 of the world water consumption is used for producing animal products, and fish and seafood, which are pretty much the last species that are still hunted by human beings, are either completely exploited or overfished. And of course, there are a lot of unintended environmental consequences. You may have heard that animal agriculture accounts for about 57% of food-related emissions. It is also a major cause of eutrophication and ocean acidification. And finally, it is also a cause of a global health problem, which is the antibiotic resistance problem. As it turns out, consumers do care a lot about those issues. And I'm showing you on the left here the reasons for why American consumers are moving towards plant-based diets. So starting at the bottom, you can see that people care about ethical reasons and the environmental impact of the food they eat. They also care about other aspects such as curiosity, which means that consumers care about innovative foods and want to try new things. And there's also a major health component. So people no longer view their foods for only their hedonistic values, but they also care about the nutritional values and what they do for their health. On the right side, you can see that what we're seeing is a generational shift. Generation Z tends to consume more plant-based meat than millennials. It tends to consume more plant-based meat than Generation X. That tends to consume more of those products than baby boomers. So really, we're seeing an entire shift in different segments of the market. Now, we're also seeing a very interesting and exceptional startup scene. We're seeing entrepreneurs who are passionate and mission-driven. And what they're doing is they're providing the products that people want, which are animal products. But instead of using conventional agriculture to provide those products, they're using different processes. And those 3 different processes can be divided into 3 different ones, starting with plant-based. Beyond Meat is the best example for plant-based products. What they're doing is reverse engineering meat by using plant-based ingredients. So they've analyzed meat at the molecular level and have identified molecules that come from plants that, when combined, can give the same texture and taste and the entire experience of meat. Acellular agriculture and cultured meat are within the category of cellular agriculture. So acellular agriculture is well exemplified by Impossible Foods. What Impossible Foods is doing is that they're using a piece of DNA that will encode heme, and these are inserted inside microorganisms that are used as factories. So as those organisms divide and they proliferate, they will produce heme, which will give meat the very metallic and bloody taste to it. And then you harvest the proteins that those microorganisms have produced, and you add them to the plant-based burgers. And finally, there's cultured meat. Those products are not yet on the market. The first company to produce meat using this process is Memphis Meats. And the idea behind it is that you can produce meat, which are basically animal tissues, by using their building blocks, which are cells. So cells are harvested in a biopsy from animals that can then go on and live their own life. And those cells are then put inside bioreactors, and they proliferate and differentiate into different types of tissues, including muscle tissue or fat tissue that put together gives you an actual piece of meat. And finally, I want to stress that these are only a few examples. And there are many, many other companies that have either entered the market or entering the market right now. On the plant-based side, we see companies such as Ripple that are producing plant-based dairy, New Wave Foods producing seafood, or just that Aldi has on the market, plant-based egg. Now, on the acellular agriculture side, there are companies such as Clara Foods, Perfect Day, and Gelter that are using fermentation to produce components from animal products. So in the case of Clara, egg proteins. In the case of Perfect Day, dairy proteins. In the case of Gelter, collagen. And finally, we have cultured meat. And what's really interesting about that space is that at the end of 2016, we've had approximately 4 companies that were out there when it comes to being the cultured meat space. But now we've seen a lot more companies that have entered the market, and today we've counted more than 40 companies. So in less than 3 years, we're now at over 40 companies, and they've really diversified. They not only produce beef, they're trying to produce other types of products, such as poultry, as in the case for super meat, seafood, as is the case for wild type, foie gras, as is the case for agriculture. And there's even a company in Australia that is producing cultured kangaroo meat. Now, the question on everybody's mind right now is probably, what is the market opportunity? And it turns out that the market opportunity is massive. What we've done is that we've looked at multiple market reports and research and have quantified how much the animal products market was worth in 2018 and how much it will be worth by 2025. We were able to figure out that in 2018, the market was worth $2.2 trillion. And this not only includes foods such as seafood, meat, dairy, eggs, but it also includes other products such as pet food, textiles such as fur and leather, or even other products such as musk, gelatin, rennet, etc. And this market is expected to grow at a fairly fast rate of 4.7% annually to reach about $3 trillion by 2025. Now, the obvious next question is, how much of this market can alternative protein companies grab? And so here I'm showing you figures from meat, dairy, and egg. And so for alternative meats, it is predicted that by 2025, about 10% of the market will likely come from alternative meat products. When it comes to dairy, within the same time frame, we're talking about approximately 6% of the market. An alternative egg, which is more of an emerging and nascent category, this market could grab around 1%. Now, honing into alternative meat products, I mentioned that by 2025, the market could be at around 10% of the total market. But what A.D. Kearney predicted is that with the introduction of cultured meat into the space, by 2040, more than half of the market, of the meat market, could come from alternative meat products. So by 2040, as much as 60% can come from alternative products. And those are just 3 out of many different categories. So there are other different markets with pretty big market sizes. So for example, there's seafood that's around $160 billion. There's pet food, 100 billion, and leather, 100 billion. So different companies can grab different parts of those markets. Now, as investors in the space, we need to understand all aspects of the market. And this, of course, includes risks and challenges. We've categorized the different risks and challenges into 4 different categories, starting with health concerns. At the beginning of my part of the presentation, I showed you some very impressive headlines about the plant-based space, but there have also been quite a few negative ones. And there have been a lot of articles that are questioning whether or not those products, so all the plant-based alternatives, are even healthier than the conventional products they're aiming to replace. And so this is a problem that startups and companies in the space will have to contend with. So what we're seeing right now is that some startups are entering the market with an interesting value proposition, where they're producing products that are either less processed, contain less ingredients, and are presumably healthier. We also do believe that companies such as Impossible and Beyond really had to nail the taste and texture of the product before focusing on health. So right now, those companies are at their version 2.0, but we believe that as they move on to 3.0, 4.0, etc., those products will get healthier and healthier. And the second part of the risk and challenges is regulations. And the regulatory landscape is quite messy and noisy. And I will be talking to you about 3 different aspects of this landscape, starting with labeling laws. So I'm showing you here a picture of a bowl of soy milk that you can find in the UK. If you look closely, you'll notice that the word milk doesn't appear there. And that's because in the European Union, you're not allowed to use the word milk to describe those products. And so such labeling laws, sorry, I should just mention that you're not allowed to use those as long as when those products do not come directly from animal agriculture. Now, those same labeling laws also exist in different parts of the world. In the United States, we've seen different states that have either passed or are passing similar laws. So especially when it comes to meat, so a lot of states have passed laws that would prevent companies that are in the alternative protein space from labeling their products as meat. We've seen laws coming from Wisconsin, that is a big dairy producer that is trying to prevent companies from calling their products cheese, cream, butter, etc. Now, those laws are being currently litigated in multiple courts around the country, and it may be that these trials will go all the way to the Supreme Court, and this will be litigated probably as a First Amendment case. Now, there's also the issue of standards of identity, which is quite similar to labeling laws, but is different in the sense that those laws have been in the books for years, and what they're trying to do is to protect consumers from fraud. So I'll give you the example of mayo. So in order to sell your product as mayonnaise, you need to have 3 different ingredients. You need to have oil, vinegar, but you also need to have eggs. And this, of course, presents a problem to companies that are trying to produce those products without the animal ingredients. And this is exactly what happened with the company Just, formerly known as Hampton Creek. They had, as you can see on the left side, a package that had a big picture of an egg, and they called their product mayo. But the FDA issued a warning letter, and Just had to come up with a compromise with the FDA. They needed to change their package to make certain things clear. So as far as I understand it, they had to remove the picture of the egg or make it smaller. They had to make it explicit that this is plant-based, and they needed to put the label spread and dressing in order to fit a potential standard of identity. I should also mention that recently the FDA has come up with the idea of modernizing standards of identity. And we believe that this will really benefit startups in the space. So the idea is that the FDA wants to modernize those in order to foster innovation in the country. So of course, startups in the space are currently the ones who are really disrupting the food industry. So we can expect them to benefit from the standards of identity. And this is something that we'll need to monitor. And finally, there's the question of oversight. And this specifically applies to the case of cultured meat. So to this day, cultured meat is not available on the market. One of the main reasons is because of regulations. So around the world, different countries may or may not have come up with some frameworks to regulate cultured meat. In the United States, the FDA and USDA came together in March of this year with a framework to regulate cultured meat, but it is true that there are still some questions that remain. Other parts of the world, the European Union has come up with a potential regulatory framework, but just like in the United States, it is still unclear exactly what is going to happen. So again, this is another part of the regulatory challenges that we will have to pay close attention to. So there are also technical challenges, and one of them especially applies to cultured meat again. And this is around scaling. So it is true that it is possible to create meat from building block cells, and it has been done multiple times in the past. For example, in 2013, Mark Post came with a beef burger that was presented to the public and to journalists in 2013. Now, the problem with this burger is that it costs as much as $300,000 to make. And this is, of course, completely impossible and unreasonable for most people that live on this planet. And so startups will have to bring those costs down. This includes having media costs. So this is basically the nutritional broth that cells need in order to proliferate and also in order to differentiate. And they will also need to find bioreactors in order to scale this process. So we've seen a company, again, Just, they have come up with nuggets right now. They've announced nuggets that are around $50 per nugget. So as you can see, the price has dramatically dropped, but $50 per nugget is still something that is not going to be particularly competitive in the market. But again, this is companies are entering the market to be the picks and shovels of the industry, and they're helping by creating novel bioreactors, trying to find solutions to bring the cost of media down. And finally, there's the question of public acceptance, of course. And I'm sharing with you again the picture I showed at the beginning of my part of the presentation. And what this picture can really serve as a cautionary tale for what can happen to companies when they lose control of their story. But we believe that companies have learned the lessons of the past and are now using completely different marketing strategies and storytelling in order to command really high public acceptance rates. So one of those strategies, for example, is the use of the word plant-based instead of vegan. That has traditionally not been very well accepted in the market. They're also using other marketing strategies, such as placing products alongside the products they're trying to replace in the refrigerated sections, as I showed you for the case of Beyond Meat, but also other companies, for example, when it comes to soy milk, almond milk, are placed just next to conventional milk. And so as you can see, there was a recent study here that I'm showing you where the acceptance rates have been actually really, really high. In places like China and India, we're close to 90% or even above 90%. And in the United States, 3/4 of the population is accepting of either cultured meat or plant-based meat. And from here, I will let Rob talk to you about performance in terms of our fund.
In this last section, we're going to talk about performance, terms, and our fund's allocation strategy. But before we get into that, I want to talk a little bit about AgFunder's unique and unfair advantage, and ultimately the secret sauce that's driving this performance. And to do that, it's really important to understand that venture capital is really a unique asset class. So basically, unlike other asset classes where anyone can buy a share in, say, Apple or a municipal bond, venture capital is the only asset class where the asset chooses the investor and not the other way around. But because it's the VCs who are the ones writing the checks, many people assume that we're the buyers. And I think a lot of second-tier VCs can make that mistake. But if you're going to be any good in this business, you need to realize that you're actually the seller. And so what do I mean by that? Well, you know, as a VC, we're not investing, if we're not investing in the number 1 or number 2 startups in a given category, then we may as well be investing in the 100th startup, because most likely that company is not going to be worth anything. And because of this fact, this sort of long tail distribution with a couple successful winners, we need to have a platform and a reputation that, 1, lets us know about the best opportunities, and 2, when we know about these opportunities, we need to have a platform that gives us leverage to get into those opportunities. And basically, we still need the entrepreneur to prioritize us over other investors, because allocation is always limited in the best opportunities. And a lot of investors don't want to hear this, but top entrepreneurs, especially at the early stages, just don't have an interest in family offices, corporations, or other non-professional investors in their funding rounds, unless your name, of course, is Bill Gates or Zuckerberg. And these entrepreneurs are very choosy with the VC firms that they work with. And so, having built up AgFunder's reputation for the last 7 years, we have a strong advantage that most entrepreneurs start actually learning about this sector from us. And every week we publish articles that demonstrate our knowledge of the industry, the scope of our network, and our thought leadership. And this builds trust. And this is why we've been able to get into almost every deal we've gone after. And it's one of the reasons why we've been able to invest with top VCs, including 8VC, Andreessen Horowitz, Breakthrough Energy Ventures, the billion-dollar energy fund chaired by Bill Gates, Data Collective, Greycroft, Horizons Ventures, S2G, TPG, True Ventures, and others. So in this slide, we're going to break out our investment performance across all investments going back to October 2017. This chart excludes investments from our Asia Accelerator, since we just launched that in September. Please note that these are venture capital investments, and they have a target exit horizon of 5 to 7 years. And so we have not exited any of our companies yet, nor do we intend to exit them early. In total, we've made 26 investments in 21 startups over the last 27 months. Of those startups that have raised a new funding round, we have a multiple of 2.08x on our investment with an IRR of 91%. And we expect this trend to continue with other companies that are maturing. Across all portfolios, our portfolio is still tracking 21% IRR. And 2 companies have recently notified us in the last couple of weeks that they have term sheets that would give us a 6x multiple each on our initial investment. So within the protein sector, we've made 2 investments actually from our main agri-food tech funds already, and both of these companies are operating in stealth. The first company we closed a couple of months ago, and they're producing cheese from plants. The round was led by one of Silicon Valley's elite VC funds, and we were one of the only new investors that were allowed in this financing. The product is incredible, and we believe this is a company that's going to be really important, and we can't wait for them to announce themselves to the world. Now, the second company is in the process of commercializing large-scale lab-grown leather and will come out of stealth in the spring. They have launch partner agreements with some of the largest and most iconic fashion apparel brands, and they just closed a new financing round just 6 months after our last investment at a 2.58x times our initial investment. And we believe we have the most compelling high-performance portfolio in the agri-food tech space. And while we certainly have an exceptional team at AgFunder, a lot of this is going to be driven by the unique platform we've built that allows us to know about and get into the best opportunities. So on this slide, we're going to run through some of the terms of the fund. We're targeting a $20 million fund with 50% of the capital reserved for follow-on. The minimum investment is $100,000 for individuals, but investors on this webinar can invest in any quantity between 25K and 100K. For investors investing less than 1 million, we'll have our first close and final close on that for December 15th. And investors investing over 1 million will come into the second and final close. And that will, which we anticipate to be somewhere in spring 2020. We currently have about 17 million soft circled and another 15 million of potential interest that we're working to firm up. We're going to aim for about 20 investments, but we may participate in with some small checks. And as you'll see, it's far more important to be in the best deals, even if it is small. And so we may exercise that optionality. The fund is structured as a standard 10-year fund with 2 one-year extensions. We are not recycling capital, and we plan to distribute capital when the exits occur, ideally sort of in a 5 to 7 year time range. But as we saw with Beyond Meat, Impossible Foods, and Uber and Airbnb, the big outcomes often take 10 years today. And we believe there is an opportunity window here, and so we'll be focused on making our primary investments over about a 2-year window, with reserves invested over the next few years in those companies that we feel are breaking out. The fund is targeting a 20 to 30% IR, and this metric really helps us constrain the kind of investments that we can even look at. Management fees is a standard 2% annual, blended higher during the deployment period and lower during the harvest period, and admin fees are low and paid at cost to our service providers. Carried interest refers to AgFunder's share of the profits after principal has been repaid to the investors. We have a 20% carried interest for return multiples up to 5x%. That increases to 25% to 5x to 7x, and 30% profit share after 7x. Michael, my founding partner, and I will be investing personally as well, and will contribute 1%. Overall, the fund aims to generate a 3x return for its investors by investing in those startups which could potentially return the entire value of the fund. And by focusing on startups that have the potential to generate a high multiple return in the 10x to 30x range, we can bake in significant margin for error that permits a high failure rate. And in the theoretical model above, we conservatively assume that about 75% of the companies return 0x to 1x, and that we basically have a single company that returns 20x. And that with this portfolio outcome and this high loss ratio, we can still generate a 3x on the fund. However, we believe the opportunity still could be much bigger because of the potential big outcomes in this market. So let's take Beyond Meat, for example. Let's assume we had a $20 million fund, and it invested $1 million in Beyond Meat Series A, and then exited in this summer secondary. The entire fund would have been worth about $400 million, basically a 20x return fund. And so even if every other single company in the portfolio went to 0, we'd have a 20x return on our investment. And with a $3 trillion animal products market up for grab, we believe that there will be multiple billion-dollar startups that can emerge from this sector. And so it is our intention to leverage our brand, network, and expertise to try to make sure that we invest in those companies and that we have a lot of shots on net to do so. So in this slide, we're going to give an overview of our allocation strategy. So at a high level, we expect to invest about 35% of the fund into plant-based solutions, 55% into cell ag, which includes acellular agriculture and cultivated meats, and about 10% in the picks and shovels. And while we would love to weigh the portfolio more to plant-based solutions because it can scale so much faster, but as VCs, we are primarily looking for technologies that can give us a strong competitive advantage. And most of the plant-based startups that we've seen, at least, have very little technology, and so very little edge there. So this is one of the rationales for sort of the weighting towards more IP driven startups. We're stage agnostic, but for all practical purposes, the industry is still relatively young. And so we expect most of the investments to be in pre-seed to Series B, although we may look to take a small allocation in, for instance, Impossible Foods, because ultimately, if we believe in this category, then we believe that Impossible Foods still has significant upside as one of the early and emerging leaders. And we have good relationships with some senior executives there. For geographies that we feel most of the opportunities will emerge from North America and the Asia region, we've underweighted Europe mostly because of the regulatory environment is not very welcoming to food tech startups. And we expect many of those startups to move to the US to launch. And just so fundamentally, we just don't think there's as many opportunities there. So this brings us to the end of the presentation. As far as next steps, if you'd like to invest, you can visit agfunder.com/protein. You can click the green invest button and use access code 7555 to sign the subscription agreement and operating agreement. If you'd like some time to review and want To reserve your spot now, you can click the reserve button with the amount. We have spots available for 25K to 100K, but those are going to be limited. So once you've signed, we'll need to verify that you qualify as an accredited investor. There are a number of services that can do this. There's free ones, and it generally involves a simple letter from your attorney, CPA, broker, etc. And it's relatively painless. And then finally, after we've verified you, we'll just send out the capital call. So thank you very much for your time today. And let me know if you have any questions. You can email us at funds@agfunder.com. Thank you.